Can you imagine that China's entire real estate market is teetering on the brink overnight? Major corporations like Evergrande, Wanda, and local developers are all drowning in debt and on the verge of collapse. Even first-tier cities like Guangzhou and Shenzhen are seeing price drops, while places like Sichuan have already abolished home purchase restrictions and price controls. The real estate tycoon of Hong Kong, Li Ka-shing, has been forced to take action, launching new properties at a 30% discount and selling out in a single day. This raises a pressing question: just how dire is the crisis when even industry titans are compelled to slash prices? What long-term impact will the scrapping of these purchase restrictions and price controls have on local governments, corporations, and the real estate market at large? Facing a series of steep challenges and a complex landscape, the pressing question arises: are simple price adjustments enough to solve the root of the problems? Will it pull companies and local governments out of financial quicksand? What ripple effects could this have on the broader real estate market and the overall economic environment? The financial health of major real estate giants like Evergrande, Wanda, and Country Garden is deteriorating alarmingly. Take Evergrande as a case in point. It has lost $81 billion in the past 2 years. Wanda is grappling with a gaping hole of at least $200 million needed for debt repayment. Country Garden's failure to meet interest payments on time has seen its credit rating plummet to junk status. It's now caught in a vicious cycle of borrowing more to repay past debts. In this dire context, the debate over whether property developers should be granted more pricing freedom has caught fire. Recently, the China real estate business published an article advocating for the loosening of price restrictions, asserting that price drops are now an unavoidable trend. This perspective received strong backing from Hong Kong real estate moguls Li Ka-shing and Li Shaoqi. In a bold move, Li Ka-shing released a new property development called the Coastal Line 2 in August with a 30% discount, and all 135 units were snapped up on the same day. Li Shaoqi took it a step further by launching a mixed-use development in Kowloon at an astounding 45 to 55% discount, effectively setting a new pricing benchmark for the market. The prevailing forecast suggests that Hong Kong property prices could tumble by 40% in the coming years. With the Hong Kong dollar pegged to the US dollar, capital is expensive. Post the anti-extradition bill movement, over 100,000 middle to high-income Hong Kongers have emigrated, decreasing housing demand. If the peg between the Hong Kong dollar and the US dollar wavers and starts to align with the ever-deprecating renminbi, the value of Hong Kong real estate could nosedive. Therefore, the dramatic one-time price cuts by these real estate tycoons are seen as a double play. They not only entice consumers who were initially reluctant to buy, but also hedge against the risks of future currency devaluation. Recent sharp declines in Hong Kong property prices have ignited fierce capital competition with neighboring regions, especially in the Pearl River Delta. Developers in the Delta are not just following suit, they're pulling out all the stops, dropping prices in some instances more drastically than even business magnate Li Ka-shing. Take Shenzhen's Luohu district, for example. One property project dramatically slashed its prices from an original 95,000 renminbi per square meter to 45,000 renminbi, a jaw-dropping 53% cut, and is throwing in free interior decor as a bonus gift. Another project has cut its prices from 12.8 million renminbi down to 8.4 million renminbi, a steep 35% reduction. These moves make it crystal clear: price cuts in the Shenzhen property market are no longer optional, they're inevitable. Aiming to attract first-time buyers and upgraders, a property project in Zhuhai, Guangdong has halved its prices, plummeting from 28,000 renminbi per square meter to 14,000 renminbi. At the same time, Guangzhou and Shenzhen have rolled out a series of market-shattering measures to rescue their property markets. For instance, Shenzhen's Manjinghua Investment Group promises to refund any price difference to buyers should the property prices decline further. It's worth noting that such a price guarantee is not allowed under financial regulations and can sometimes even be considered financial fraud. The very fact that developers are still choosing to take this legal risk lays bare the desperate liquidity crunch engulfing the real estate market. Complicating matters, the Shenzhen government has not yet intervened, ratcheting up market uncertainty to dizzying levels. In Guangzhou, authorities are contemplating the introduction of a new housing ticket system, common in smaller third- or fourth-tier cities, as an alternative to traditional relocation housing. This is raising eyebrows as the same scheme led to a real estate market crash in Heilongjiang's Hegang city, where properties could be scooped up for a few tens of thousands of yuan. The adoption of such a strategy in first-tier cities like Guangzhou could set a chilling precedent for housing prices across other major cities. The loosening of property regulations isn't just a trend in the Pearl River Delta, it's rippling into the Yangtze River Delta as well. For instance, Jiaxing, Zhejiang Province recently introduced 21 new regulations, removing all property buying restrictions and even allowing individuals to buy up to 10 properties. This move signifies a clear change in local government's attitudes towards the real estate market, notably without any intervention from the central government. Meanwhile, smaller cities like Ya'an in Sichuan are also showing signs of policy relaxation. The local government explicitly allows group buying discounts to be excluded from the 15% limit on property price reductions, firing what's been seen as the first shot in policy-driven price cuts. Several other cities like Changchun, Huanggang, and Bazhong have also expressed explicit support for group buying discounts. These developments collectively underscore that lifting the price drop limitations and allowing property price reductions have become the general direction for the entire real estate industry. The myriad of policy shifts and price cuts sweeping across the region points to a single unsettling truth. The real estate market is on shaky ground, and dramatic changes are unfolding at a breakneck pace. Last year, confronted by a sluggish real estate market, various cities rolled out a limit on price drops. Hunan's Yueyang was the first to pull the trigger, capping the price drop for new homes in the urban area at 15%. Soon, dozens of cities, including Zhuzhou, Guilin, Hezi, Kunming, Shenyang, Jiangyin, Tangshan, and Jiangjiakou followed suit. Even cities that didn't officially announce such policies were subtly manipulating the extent of price reductions behind the scenes. Take Kunshan as an example. In May, 2 housing projects were forced to halt sales and were fined for reducing prices by as much as 30%. Behind this sweeping intervention in housing prices lie 2 main drivers. Mitigating systemic financial risks. The real estate market is intricately linked with several industries: banks, construction, furniture, steel, and household appliances, to name a few. Banks in particular bear a hefty load of real estate loans. A drastic decline in house prices would not only lead to a wave of loan defaults, but could also trigger a more extensive systemic financial crisis. Preserving revenue from land sales. Local governments heavily rely on the revenue generated from selling land as a financial pillar. A steep drop in land prices would directly cripple their fiscal income. Despite these efforts, the limit on price house drops have hardly met their intended goals. House prices continue to tumble across regions and land remains unsellable. According to data released by the National Bureau of Statistics for July, out of China's 70 major cities, 70% have witnessed month-on-month declines in new home prices. Furthermore, in 63% of these cities, new home prices are lower than the same period last year. As for the secondary housing market, a more direct reflection of property price changes, the numbers are even more stark. In over 90% of the 70 major cities, prices are not just dropping, they are lower than they were a year ago. Here's some real-time feedback from netizens on the housing market across different cities. Beijing, down by 5 to 10%. Chengdu, down by 20%. Xiamen in Fujian, down by 15 to 30%. Suzhou's prices are also dropping. Yuhuatai in Nanjing, a district with school-zone homes previously priced at 38,000 yuan, can now be bought for just 20,000 yuan. In the realm of land sales revenue, the downturn is gathering steam. In 2022, national land sales revenue stood at less than 7 trillion yuan, marking a 23% year-on-year decline. Fast forward to the first half of this year, and the number plunges further to 1.86 trillion yuan, tumbling nearly 21%. Based on this trajectory, this year's full annual revenue from land sales is projected to be a meager 3.5 trillion yuan. To put this into sharper focus, let's look at some extreme cases. In Wuhan, land sales revenue for the first half of this year was just 17.5 billion yuan, plummeting a jaw-dropping 83% from the 102.8 billion yuan in the same period of 2021. In Nanning, the decline was even more dramatic. Revenue shrank from a peak of 59.6 billion yuan in 2020 to a paltry 3.1 billion yuan in the first half of this year, essentially evaporating by 95%. In second-tier cities, not a single one managed to complete even 40% of its land supply plan for the first half of the year. Even Hangzhou, which fared the best, only managed a 32% completion rate. Why are lands gathering dust? The stark reality is that most real estate companies have halted land purchases. Nearly 60% of the top 100 property developers have yet to start land acquisition in the first 7 months of this year. And even for those that did, the pace has been noticeably slackened. So why have property developers put land acquisition on ice? Thanks to a sluggish market and a slew of government price drop limits, sales across major property firms are on the decline. Only 2 companies, Overseas Chinese Town Group and Beijing Urban Construction Group, saw positive growth in sales in July. Other privately owned real estate firms without other financing channels are virtually holding their breath, awaiting the lifting of price caps so they can offload properties, recoup capital, and stave off a debt crisis. Yet, tragically, the exact price drop limits that were meant to stabilize the market have paralyzed sales. And the added extra burden of obligatory educational building projects have pushed real estate companies to the brink of financial collapse. Since May 2021, 22 property firms have found themselves in dire financial straits, with the most recent being Country Garden and Sino-Ocean Group. Under such dire circumstances, the Chinese Communist Party must realize that government bailouts alone won't suffice to rescue the hundreds of beleaguered property firms. Only by lifting the price caps can firms possibly stimulate cash flow through price reductions, thereby enabling them to repay debts and complete construction tasks. Simultaneously, land prices also need to be adjusted to lure more property firms into the market, thereby boosting local government revenues. In a nutshell, the drawbacks of price drop limits far outweigh their benefits. Since the release of this real estate report, societal acceptance of property price adjustments has notably increased. As cities desperate for change take bold first steps, smaller third and fourth tier cities are likely to follow suit, leaving mid-tier cities little room to resist this sweeping transformation. Even if the central government hasn't explicitly lifted restrictions on property price declines, local governments often take matters into their own hands, guided by their unique circumstances. This is encapsulated by a well-known saying within the Chinese Communist Party, quote, "The top sets the policy, the bottom finds the countermeasures." In the roller coaster of the real estate market, local government strategies and market reactions often play pivotal roles. In economically robust regions like the Pearl River Delta, the fall in high property and land prices barely makes a dent in the local government coffers. Conversely, in economically lagging areas like Yunnan, where property and land values are already modest, a price slump could set off a domino effect. This will drastically drain local financial resources. Here, local governments become almost entirely reliant on fiscal support from the central government. If this fiscal strain becomes widespread, even the central government could find itself under immense financial pressure. This may force local governments to explore alternative avenues, like attracting foreign investment or striving for greater economic autonomy. Such moves not only widen the policy rift between central and local governments, but also introduce a slew of complex governance challenges. Looking ahead, the sustainability of land-based fiscal models is on shaky ground. Although China is consciously pushing high-tech industries to bolster tax revenues, international constraints, especially U.S. sanctions in key technology fields like AI, semiconductors, and quantum computing, make this strategy increasingly untenable. Reinvigorating exports to alleviate China's economic woes is no easy feat either. Traditional export models are crumbling. With no high-end technologies or services to offer, China finds itself in an economic straitjacket. The once high-flying real estate market is now turbulent, with many companies burdened by massive debts, particularly in US dollars. A failure to make timely repayments would snap the financial lifelines of entire industrial chains. Besides economic strains, China faces external pressures from currency fluctuations and international political tensions. The Chinese Communist Party's ability to manage China's economy and politics is being severely tested. History shows that they've often stumbled at crucial junctures.